This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
What's grocery shopping day at your house?
Whenever no one else is at the grocery. So, yeah. So
are you guys like us? I swear I'm at the grocery store 4 times a week, and I try not to be. I don't like going there.
So what we have found is because we have 2 small people that live in our home and they have various practices in the evenings, we find ourselves on the other side of town. We have an hour-and-a-half soccer practice to wait through. So that's when we'll typically go. So we're at one of the Krogers or the Sam's Club or the Costco on the other side of town. There's nothing else to do.
You're like, it's here. Let's go.
And since it's usually in the evening, 6:30 or 7 o'clock at night, there's almost no one in there. I was about to say,
that's a lovely time to go.
We get very lucky. Yes. And it is awesome. I remember the last time, it's been a few weeks now. The last time when I went to Costco on a Saturday afternoon, I swore to myself
never again.
I will get rid of my membership to ensure that I never make that mistake again before I'll go during that period of time. It's not a joke.
Rough.
I'm dead serious.
It's not for the faint of heart.
And here's the thing. I know that the people that work there are efficient. I know that what I get there is good quality. La, 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 la.
It's not about that. It's about everybody else in the world being there and wandering around like
and
it's
of course
Disney
their
World.
Carts are the size of Volkswagen Beetles. So imagine everyone has got their own cart. Those people that you love, because it's me sometimes too, they got their hands propped over the thing, they're leaning
strolling
over, they're barely slumping, walking, and you're like, all I need are big baking potatoes and some bacon.
Bag of lemons.
That's it. 2 things. And then you realize that you've waited behind all these folks that are slumped over. We assume that they're fogging a mirror, like they're still alive as they're pacing down, only to find out that you have those 2 items. And then the line for the checkout is like 45 people deep, halfway through the back of the store before you can get into one of the checkout things. Yeah.
All right. So
anyway, Monday night around 7 o'clock, that's when we do those things now.
Costco shopping on a Saturday afternoon, or thinking that you can just run in for a bag of baked potatoes because it's nearby on a Saturday afternoon at Costco.
Yeah,
regrets as you're pointed out.
For sure.
As you're pointed out by Jon Hicks. Everybody, stay away from the Costco at 2 o'clock on a Saturday. Hey, speaking of regrets and spending our money, let's talk about the work that you do, and to help us avoid. See, and this is a great point. You teach us about don't go to Costco at 2 o'clock on a Saturday. Don't make poor decisions when it comes to your income strategies for retirement. You've got a wealth of knowledge to share on all different aspects of life, Jon.
Absolutely.
Let's talk about this latter point. It brings me to a sad, at least an upsetting story, because there was this woman, I found this article online. A woman wrote into an advice column, and basically, long story short, she's going on the record saying waiting until 70 to take Social Security was the worst decision of her life.
Ooh.
Let's dig in. So now she's getting over $5,000 a month.
That doesn't sound bad.
That's right. And this is exactly her point that she's making. She's getting over $5,000 a month now. She would have gotten half of that had she filed at age 62.
Sure.
Which she points out, it looks great on paper, but the problem is that life is not lived in monthly installments. So she said, and I quote, "I spent years telling myself I was being responsible by waiting, watching friends travel and enjoying their early retirement while I kept working. Sure, my check is larger now, but at what cost? The money I'm finally receiving cannot buy back the health and energy I had in my 60s.
Isn't that unbelievable and so
breaking,
poignant? I love that line. She said, life isn't lived in monthly installments. The reason why that is such a good line is because I cannot tell you, Heather, how many people I run into over the course of a year.
Yeah.
And they are looking at their spreadsheets thinking that the spreadsheet is the game that they're trying to master.
Got it.
They think that that's the actual thing. Guys, the spreadsheet is a reflection or a representation of a part of your life.
Yeah.
Life is what we want to win. So in this example, and this is the craziest thing, but it's true. So she waited to age 70 to get the highest Social Security payment, only to find out, well, now she doesn't feel as good. She doesn't want to travel as much. All of her friends have already done all those things, and she unfortunately is miserable. This is almost exactly what happened to my parents. A little different. They weren't waiting on the biggest bucket from Social Security.
Yeah.
But when my dad decided he wanted to retire, he kept just pushing it off another year, pushing it off another year, pushing it off another year until he ended up having a stroke. And he was unable then at that point in time to actually travel and do things. So my mother was almost 9 years younger than my dad. When my dad had a stroke at age 69, my mom was only 61.
Yep.
And they were not able to travel at all. Why? Because he kept putting it off. He kept delaying retirement. So this is one of those situations where every single time I'm meeting with someone in the office, what I ask them is, the money will play itself out once we figure it out what you want it to achieve. What is it that you want to achieve? The money will play itself out once we figure out how to get you most efficiently to where you want to go. Because in my opinion, because of this lady's story of basically she's got a ton of income now, more than she would have had, but it's at a time when she can't even use it. It's not even fun to use it.
Right.
That's why I want most of my clients, people that come see us, I want you to understand, I want you to front load retirement. I want you to think about all of those great things that we fought for, we saved for, we gave up things for, so that when we did get closer to retirement, we thought or we think we can do some of these things. I want most of our clients to do that in the front end of the retirement for two reasons. And this lady's story is perfection, because that is the youngest that we're potentially going to be. And that is often the healthiest that we're going to be is in the beginning part of retirement. Now, why do most financial advisors not tell people to front load retirement? Because they're fearful that there won't be enough money because they're not very skilled at creating retirement portfolios. It's the truth.
I was about to say, is it that the type of advisor that does, there's growth advisors and then there's retirement planners, and it's two very different specialties?
Unbelievably different ball game. So if someone says, John, I want to, I'm 40 years old, I want to go buy a yacht one day. Chances are, that is not my style clientele, because that is important to them, but that is not important to me. To me and to my staff and all the financial advisors, all the retirement planners in our office, what I want people to know is, hey, when you get to the point where you're thinking in the next 3 to 5 years, you may not want to work anymore, or you may not want to do that job anymore, or you may want to relocate, or you may want to downsize. And you really just want to figure out with what you've saved, can it do the things you need it to do so that you can be comfortable in retirement, right? Because there's all kinds of things. Can I protect what I got? Can I create an income stream I can live off of? Can I give the least amount legally allowed to the government for the IRS and pay the least amount in taxes? Well, if something happens to me, can I be certain that's going to go to my family and not to the government? And then how do I take care of healthcare costs? Those 5 major things are what we all want to figure out. So for me, my whole thing is like, well, how can I kick off retirement with a bang for these clients? How can I say, yeah, you thought you couldn't do that Mediterranean cruise? You absolutely can. And you can potentially do it in the first 18 months of retirement. We want to make sure we select the right one, the right time, the right thing, because we may not be able to do a ton of these, but let's get it right. Let's make sure that we're not doing it on the cheapest boat in the worst time of the year. Let's do it right and give you something to talk about. And to me, it's a psychological effect. Not only is it, I know that we can create the plan to accommodate that or a portion of it. The main thing is that I want something for those clients to talk about for the rest of their entire retirement. And if you think about that, you think back about, man, that one great time that you rented that lake house and the grandkids came down. You talk about it all the time for years and years and years and years. That joy, that opportunity is something that most people don't really think about until it's too late, right? So one of the things that my advisors do, because I've trained every single one of these guys the same way, I want them to understand, I want you to be the sounding board for finding out what are great decisions that those folks can make, but how can they spend their own money in a way that makes them feel great? Not just better, not just comfortable, but makes them feel great. Do they want to give more to the grandkids now? They got plenty of money. Why wouldn't they do it now? Why do they want to wait until they're gone?
Right.
Let's do their giving while they're living. Right. Instead of just going on a Mediterranean cruise for 2 people, maybe they rent a lake house for the whole summer. And because they've got 3 or 4 kids all spaced out. But that way, each one of those families can come and visit them for a couple weeks or however it works out. And you can see that family, but still get those opportunities. Those are great uses of money that you may not see in a spreadsheet. That spreadsheet is not going to show you all that joy and all that excitement and all that buildup and all those memories and stories you're going to have. But you can do that if you're speaking with a real advisor who understands that, right? For most people, when they're thinking about retirement, that's their first retirement. Potentially their only retirement.
Right. Hopefully first
For our
and last.
office,
Yeah.
I mean, collectively, we've seen thousands of retirements. No joke, thousands of retirements where we're trying to look at how can this person go from point A to point B and enjoy it, right? It's not just about, hey, we can't do that or we shouldn't do that. It should be, we can do these things. Here's what we're trading off in order to be able to do those things, but we can absolutely do that. And those are the things that we want to put the most weight into anyway. So we tell a lot of clients all the time, don't get hung up in having the spreadsheet look the best. This is not about winning the spreadsheet game. It's about winning the life game, right? That's what we want to talk about. So much math is involved in what we do. But at the end of the day, I want the clients to be happy. I want them to know that this is what they put all of that work and blood and sweat and tears into. Let's make it the way you want it to be. This is the first opportunity many folks have to reinvent themselves, to use their time wisely. And if we do that well, it is truly a life well spent. So if you don't know what you want to do in retirement, that's fine. But speak it out, talk through it, or get a second opinion from a skilled fiduciary advisor who not only understands what it means to have a pile of money, but how can you live off of it to give you what you want so that you can harvest it for your needs first.
Jon and his team at J. Hagan Capital ready to help you out with that second opinion, help you understand what's really going on with your savings and investments, all in effort to give you the spending confidence that you deserve for retirement. So let's start that conversation. Give us a call. 502-317-0840 is the number to dial right now. 502-317-0840. A teammate standing by off the air to help you schedule a time to have a phone conversation with one of our advisors. This is a no fee, no obligation initial step in the planning process, just a space where you can ask some questions and get some information about how Jon and his team at J. Hagan Capital can help you have this spending confidence in this next phase of your financial life. 502-317-0840. Give us a call right now. We've opened up 5 spots on the calendar just for radio listeners today. If you're 5 to 10 years from retirement, if you've saved at least $500,000, that's where you're really going to see the power of this kind of planning take effect. And at J. Hagan Capital, Jon and his team, they want to show you what they can do for you in a plan that's customized to you and your goals. 502-317-0840. Give us a call right now to set a time on the calendar. It's 502-317-0840. Mr. Warren Buffett. The world is a little bit different, everybody, now that he is retired, semi-retired. Will Warren Buffett ever retire? Probably not.
No, I don't think so. No, he's passionate, about how to invest in those things, and he's been very good at it. Yep. So, he'll just be a lot more quiet. He won't be responsible for leading all the investment committee stuff, but I guarantee you, there's always a little idea that maybe Warren is listening in on this one or reviewing your memos. That's my guess.
Not an idea. He was sitting in the audience. So Berkshire Hathaway recently had its annual meeting. For the first time in 60 years, CEO Warren Buffett was not on stage, but he was sitting there in the audience. Just like a giant fairy godfather, just there to just spread his Warren goodness over the crowd. So CNBC later after the meeting was asking him about how he sees the stock market right now. And this is what Warren Buffett said.
I've compared the markets to a church with a casino attached, and people can move between the church and casino. And I would say there are more people in the church and more people in the casino, but the casino's gotten very attractive to people. It's gambling, just totally. So we've never had people in a more gambling mood than now, but that doesn't mean that investing is terrible.
We've never had people in a more gambling mood than now. Are you seeing that trend that what Mr. Buffett was saying?
So Buffett's just comment, that may be as sharp as anything I've heard him say in quite some time. So first of all, I've heard him often, talk about, investing in general, some of it with speculation or gambling or casinos and things like that. I think a lot of people in finance have done that. But this is the very first time that I've ever heard Buffett use the analogy of saying this is kind of like a church that's attached to a casino, or a casino that's attached to a church. This is the very first time.
Notify the church elders. There is picketing to be done. Get your signs, ladies. Clutch your pearls.
I'm telling you, it's amazing to think about how hard that hits right now, because not only did he say, he didn't imply this is new. He's like, and people can move freely between the two. They can go from the synagogue or the church, to do their thing, and then they move right back to the casino, and then they can come back and forth. He said, but there is right now, for whatever reason, more people in the casino than ever before. Mm-hmm. And guys, doesn't it make sense? We have basically nearly all-time market highs. I mean, any given day can be 2% above or 2% below. It's just how it goes right now. But we're closing in on really big market numbers. On top of that, we're going almost 12 years deep of this bull run. And on top of that, we have an administration, whether we love it or hate it, doesn't make any difference, who is seemingly trying to do things that they think will improve the economy in the long run. So when you look at those things, it makes sense that a lot of people have watched NVIDIA go through the roof, watch Microsoft, Amazon, and they're looking at that going, well, I don't want to sell it now. It would be a terrible time to sell everything now. I want to hold on to this and keep riding this sucker up and maybe even betting a little bit more. So Heather, I had a guy that was calling in the other day and a client, and he was just like, John, I really want in on this SpaceX IPO. And not only do I want in, I want to put like 50% of my life savings. No. And the guys on my team are just like, oh my gosh, John, this is not only a bad idea, this is a horrifying idea. Of course it is. To put all of the money that we have spent 30, 40, 50 years, okay, because this gentleman is in his 60s.
Okay.
And the point is that is there a possibility that SpaceX or Elon Musk or any of the people associated with this could end up having an unbelievable, awesome run in the stock? Of course, it could happen. Mm-hmm. But when we're thinking, guys, out there about should we gamble, this is exactly what Buffett was talking about.
Okay.
For some reason, we get affixed in this idea of, oh my gosh, look what I might be missing out on, that fear of missing out, or look at this opportunity. If I don't jump in this thing with SpaceX, or take your pick on any highfalutin thing, if I don't do that, it may fall apart. But guys, understand one thing. Why do casinos exist? Well, they exist because they make money. As a matter of fact, they print money. So in 1946, Heather, I'm not sure if you're familiar with this guy, a guy named Muggsy Siegel. Muggsy Siegel took $6 million and started a little hotel out in Vegas in 1946 called the Flamingo.
Got it.
And believe it or not, when they were supposed to open the Flamingo in 1946, unfortunately, it was a horrible downpour. There was all kinds of issues, and they had to actually cancel all the flights to come into Vegas that were going to bring in all these high flyers to the Flamingo. And because of that, the Flamingo didn't have that opening celebration that they thought they were going to have. As a matter of fact, they lost money month after month after month after month for almost 7 months. But here's the crazy thing. Most casinos, when they're done correctly, they don't fail forever. So after those 7 months, believe it or not only did they turn around, they started printing cash. As a matter of fact, the most amazing thing about most casinos in Vegas, they always make money. They're in the business of making money. Now, what Buffett was talking about, though, is that people are going to the casino. Now, are the players, are those people the consumers? Are those the winners? Or is the house that's the winner? Ladies and gentlemen, the house is who wins. And most of the people that go play in that casino, they'd be better off in the church. Because most of the time, they're probably not going to win those games. That's just how it works. So when you're thinking about Muggsy Siegel in the situation, here's the craziest thing. He ended up having some bad blood, some feuds, if you will, out there with maybe some other casino owners. He ended up being shot long before he ever saw that casino go profitable. But did that change its profitability? No. And so when you're out there hearing all these speculators and all these people saying, oh, it's going to go through the roof, chances are they're playing with part of house's money, or they are part of the house. The big brokerage firms, the wirehouses, the people that make money on all the trades, they're making money off of all the people that are going into the casino. So mark my words, is very interesting, but very important also that Buffett is saying, hey, a lot of people are speculating when they shouldn't. Casinos are great businesses if you own the casino. But if you're playing in the casino, not a good thought process, especially as we get closer to retirement. We should be taking some of those eggs out of that sum basket, that risk basket, and we probably need to be focusing on things that give us income. Maybe buying into something that can generate an incredible income stream, like a casino. Now, should we all go invest in casinos? Absolutely not. But the point is that casinos make money and they send off income. Same thing with dividend-paying stocks. Same thing with putting your money in good quality investments that pay you an income. Income's what we should be looking for, not the home run hitting, because if the chances of striking out, unfortunately, are way too big, when it comes down to especially nearing retirement time, right?
Right. You don't want to be gambling with your life savings, particularly once you've got to retirement and you have plenty of money. So understanding what chips to leave on the table and what chips to take off the table is what Jon and his team can help you figure out. 502-317-0840 is the number you can call to set some time to start the conversation with Jon about balancing your risk. 502-317-0840. We're also at retirementsolutionradio.com. We are seeing all the market run-ups. We don't want to miss out. A lot of people have made a lot of money over the last decade, if not 15 years. But again, getting close to retirement. So how can we establish some guardrails around our savings without missing out on all the great market opportunities that currently exist?
Yeah, so there are so many attractive ways. And this is the crazy and positive thing about how the financial industry and landscape have changed really only past 10 to 15 years. Like, there are so many ways that the average investor, me included, we can invest into good quality things that have the opportunity to run up a lot, but they have safety nets, or they have guardrails, or they have hedges in place to where we can't lose as much. A lot of these, we can even get in exchange traded funds, which is kind of like mutual funds, where we can actually buffer our risk, where we can say, hey, I'm going to invest in certain type of assets, but I'm going to limit my risk to, let's say, 10% of what I put in, or 20%. And there's all kinds of these things, Heather.
Okay.
Whether we're looking at buffered ETFs or barrier exchange traded funds, there are market linked CDs, believe it or not, which would be like a certificate of deposit held by a bank, issued by a bank, but instead of them just paying you 3 or 4%, they may give you a percentage of whatever the stock market does, like all the way up to 8% or 9%. Those things exist. So we're not just locking in our money and only getting 3 or 4%. We could potentially do much better. I've actually seen some of these things, and many of these are called either structured notes or principal protected notes, where you can actually do this based on artificial intelligence type stocks, or you can do it on tech stocks. So what would that look like? Well, someone that says, Jon, I really think that all this stuff that Elon Musk is doing looks really good. I like all these things all these technology companies are doing. I don't know that I want that much risk. How can I participate in some of that upside without being punched in the mouth if things go wrong?
Right.
Well, these are one of those great opportunities for some of those alternative style investments or hybrid style investments, where they mix in the upside of maybe like tech stocks or indexes like the NASDAQ or the S&P, but they have a tremendous amount of safety. And some of them, you can literally have zero risk whatsoever. You're actually going to be insured by a bank or an insurance company. That's about as strong as we can get as far as protections go, right?
Okay.
So when we think about that, and some people say, well, I don't want that much protection. I don't need guaranteed safety. But Jon, can I limit my downside exposure? Sure. You can use options or derivatives or hedges on your own accounts, even if you have them at like a Charles Schwab or a Fidelity or things like that. You can put these on anything. The question is, what is appropriate for you? What does your portfolio need from you as far as safety so that you can live your life in retirement? So it's less about the product and much more about the process. If we understand how we're protected and we stick with that, chances are we're going to win in the long run. But these are things that you may not have been exposed to. Your advisors may not tell you about that, but they're out there. So if this is something you want to find out about, should they be a fit for your portfolio or should you consider them, reach out to our team and just get an idea of where you are, where you want to be, and let the process dictate the type of products you select and not the other way around.
That number to dial to reach out to Jon and his team. It's 502-317-0840. 502-317-0840. Give us a call right now. We've got a teammate standing by ready to answer your call and help you set up an initial conversation with one of our advisors to go through some of your questions. They will share with you some of their ideas and ways that they might be able to help at J. Hagan Capital, help you figure out how to not have the FOMO, but also not be gambling with your life savings. There's lots of opportunity in the market. At J. Hagan Capital, they want to know you, how to create a strategy that you're comfortable with in your retirement years. 502-317-0840. Give us a call right now to set a time on the calendar to start the conversation with Jon and his team. You can also go to retirementsolutionradio.com. or it's 502-317-0840. Why is it that even the most successful just can't seem to ease up, unclench, and relax for retirement? Is a question that you battle regularly, Jon Hicks. I want to bring up this article that I read on marketwatch.com because it is baffling, but I feel like you're going to hear it and you're going to be like, yeah, Tracks. So this guy, he's 71 years old. He wrote into an advice column on marketwatch.com. He is retired. He has $2.7 million in an IRA, $470,000 in stocks, a pension that pays him $4,000 a month. His Social Security also pays him $4,000 a month. His house is paid off and worth $750,000. And he has a part-time job. And he says he cannot relax because he's worried about running out of money. And one hears this setup, and you're thinking to yourself, wow, this guy has got it good. He is living the high life. And he's sitting here going, nope, I am stressed all the time.
Absolutely. The amazing thing is a lot of folks have a really tough time trying to figure out how to bridge the gap or the difference between I've been working every day, putting all this money into my 401k, growing all this big pile of money, to go from there to all of a sudden a psychological shift of now I need everything that I've been doing to end. I'm not going to be feeding this beast anymore. And instead, I need it to start sending me money. Instead of me feeding it, I need it to feed me. And the craziest thing is that, Heather, it doesn't matter if someone has saved hundreds of thousands or millions or even, not a joke, tens of millions of dollars.
Yeah.
It just changes everything. It's not a financial issue, although it feels like one, because it's always about money, money, money in our head. But believe it or not, it's a psychological issue. A psychological issue because all of the things that we've been doing for the past 20, 30, 40, 50, some of us 60 years of work and putting money away and waiting for a rainy day to use it or waiting for a retire. And all of a sudden, we're disrupting that 40, 50, 60 years, all because things are about to shift. So here's a crazy thing. Do you know, and very few people would know this, do you have any idea who Hetty Green was?
No.
Oh, it makes sense. She passed away in 1916.
Oh, but wait, no, I think I do know who Hetty is. Please continue.
There we go.
Okay.
Hetty Green passed away in 1916. She was considered and called the Witch of Wall Street. She was one of the most wealthy, if not the wealthiest female in the world when she passed away in 1916. She was worth supposedly a little over $100 million back then, which today would be over like $3 or $4 billion. Here's the crazy thing. She was called the Wicked Witch or the Witch of Wall Street because she was notoriously so frugal, so crazy, so bent on saving pennies that frankly, it destroyed her life. So most people don't know the story, but I can't remember what year it was. She had a son. I think it was her only son. I think his name was Ned, if I'm remembering the story right. Well, Ned had an issue with his leg. So even though Hetty Green was an unbelievably wealthy person, she went to the free clinic with her son. Free clinic with her son to have his leg looked out. Here's the craziest thing. They told her, hold on, when they found out who she was, Hetty, whoa, you got all this money. This is a free clinic. You're going to need to pay. She ran out, didn't pay the bill, and started doing the medical procedures on her own. Here's what happened. Her son ended up getting an infection and ended up having to get the leg amputated. Now, the reason I'm saying all this is because even though this is a crazy, outlandish story, it happens every day because it is not financial. It is psychological, the things that happen to us as human beings. So this is a lady who wanted to be so frugal. She was so worried about all the money things that she basically caused, in all honesty, she caused her son to lose his leg because of being so mentally unready for this concept, right? So this is what happens to all of us when it gets to retirement. All the things that we've been doing, the working, putting money away, it changes. And now we need to pull from it. And for the first time in our lives, we start to freak out. We start thinking, did I save enough? Because every month, the cost of beef keeps going up. The cost of gas may keep going up. The cost of oil, all these things keep going up. Airline tickets, vacations, and that's not even including just cell phone bills, more taxes on things like communications and Federal Trade Commission stuff. It keeps adding up. And guys, it is a mental exhaustion. Right? So when people say, oh my gosh, I just don't know what I'm going to do next, I'm freaking out. I see it all the time, every day. And so one of the biggest and most fundamental things that any skilled and holistic advisor can do is show people the actual math and to go ahead and try to put to bed some of those biggest fears. Because sometimes you have to see what would happen. What would be the worst case scenario at this point. And when some people see, like the gentleman we're just talking about, $2.7 million in this, pensions, Social Security, all those things, in his mind, his whole point is, but how do I know? How do I know it's enough? What happens if the administration changes things? What happens if Congress changes things? What happens if there's a flip-flop in a midterm? What happens long after that? What happens if another party comes in office? What happens if we have a geopolitical nightmare? What if we don't, do this, do that? And we just all of a sudden get flummoxed, and it causes us to make poor decisions. But the craziest thing is there are 3 things that every single one of us can do to not only feel better about things going on, to actually live life in the next paradigm, which is the paradigm of being able to retire. Number 1, you have to do the math. You have to see the math on paper. Number 1, how much of your money is protected? How much income can it create? And what is the likelihood that even if there's a down movement in the market, or inflation keeps going crazy, or interest rates, the whole point is you want to stress test it just to be certain that you have 9.9 out of a 10 scale of being able to hit your goals. So mathematically, number 1. Number 2, you want to know where the income's coming from, right? Mm-hmm. So whether you're deciding to work on some crafts and sell them on Etsy, or you're wanting to go flea market and find, the diamonds in the rough and find a $200 credenza that you finish up and you can sell for thousands of dollars, whatever you want to do, part-time work, pension income, dividend income from your portfolio, all those things, you want to know where's that income coming from. And lastly, you want to make sure, how do you keep it away from the government? How can you know if you're going to generate $50 or $60 or $80 or $100,000 of income? How can you know that you get to spend it and it's not going to go for more tax bills or just more bills, right? So that is what a skilled holistic advisor should be doing. It should be based on a process, not on a product. I have rarely, if ever, seen products fix people's issues when it comes to psychology, but I see math fix it every single day. If we've done the hard work of saving the money, and then we've done the second hard work, which is using the plan and the procedures on how it gives us that money, guys, we can basically relax every day knowing our floor of what our income should be in retirement, and then knowing if we wanted to blow it out, and lift really high off the hog for the first 3, 5, 7 years of retirement, we can know what that looks like too. And if we do that correctly, it's really hard to overspend, but it's all about psychology. This is one of those things that even if someone's been awesome at saving money, they've got millions of dollars sitting in a bank account or in their 401k or in their IRA accounts, this is where it is really good to find out, how do you take that big old pile of cash and how do you turn it into a true plan and a process to not only give you money for you to live off in retirement, but allow you to do all of the things that you want to do. And what I tell my family too is, listen, guys, we can't do everything, but there's a chance that we can do most things we want to do if we plan well for it. That is a life worth living, because we get out of the fear, out of the psychological parts of things, and into the real life of the math, which is easy to compute. We can all do that, but we have to start at the phase 1 first, which is finding out what we really want to do and getting to that point.
Of course, Jon and his team are here to help you with that math. Reach out. Our number is 502-317-0840. Call us right now to set a time on the calendar for an initial no fee, no obligation phone conversation with one of our advisors. 502-317-0840. You can also go to retirementsolutionradio.com. Thinking about the psychology of it all, the story you told about the woman, the Witch of Wall Street, somebody listening to that story is going to scoff. I would never do that to my child or my grandchild. I will take care of my family. And to that, we say, of course, you would never do that to your child. But think about this, dear listener. Turn the mirror on yourself. What are you doing as far as your own health deprecation? Because I know that's another conversation you've had to have with people, Jon. Absolutely. Sometimes it's as simple as, go getting insoles for your shoes. And I know they're expensive, guys. I mean, really great places, they're $300, $400, $500 for really good orthotics. And people won't spend that, amazingly enough, when we talk to them and they realize, oh my gosh, I do have enough money to do that. And they get those new insoles for their shoes, their back pain goes away. They feel like moving around more. They feel like hanging out with their grandkids. They feel actually like going to that ball game to watch their grandkids play, simply because of a $400 or $500 or $600 investment that they've been unwilling to make in themselves because they didn't feel like they had permission to spend it. That's what really great advisors can do. They can help weed through, hey, what are great expenditures or even investments even into your health or your opportunities or your bucket lists, as opposed to just looking at everything as an expense. But I see it every day.
people just being, unhappy or ill content in retirement because they don't realize that they should have permission to spend on those things. Those are the biggest pieces of the puzzle, where even great savers and people that are even good with investments, they really need to get a second opinion, a second set of eyes on things, so they can see, oh my gosh, I see what you're saying, John. I've got 4 pairs of shoes. And even if I spent $600 on each 4 of those pairs of shoes for new insoles, that's less than $2,500, and I would actually live my life without pain, and I'd actually be more mobile. Yes. Or maybe going downscaling or changing homes from a 2-story where you got to go up and down stairs every day to just a ranch, or maybe a patio home, or maybe find those things that improve life. But guys, those are not expenses. Those are investments in yourself. And what you want to find is an advisor who just doesn't talk about investments. It's what can those investments do to actually improve the quality of your life. That's what it boils down to. That's why it's always a process over a product.
And above all else, having the plan in place that's going to give you the confidence that you deserve, the permission to spend your money in retirement. That's what John and his team want to help you figure out. So give us a call. The number to dial right now, 502-317-0840, 502-317-0840, to set a time on the calendar for a no-fee, no-obligation initial phone conversation with one of our advisors. If you are near or in retirement, if you've saved at least $500,000, that's where you're really going to see the benefits of the kind of planning they do at J. Hagan Capital. And they're here to answer the questions you likely have. 502-317-0840. You can also go to the website. It's retirementsolutionradio.com, or call right now to set a time on the calendar for that no fee, no obligation initial conversation. 502-317-0840. People are retiring, and they've got spending plans, and the results are in. It's not going the way they want it to. I'm not laughing at people. I'm laughing sympathetically because as I feel like for a lot of Americans, we just get so frustrated. It's like we feel like we're doing things right, and then we end up finding out we're doing it wrong, which is why you're here, John. You are here to give us some information, some things to chew on.
Absolutely.
So thank you very much. Now, this is where I have fallen short. I don't know if this is just based on people that were DIYing, but there was a study done by Nationwide Retirement Institute. They asked people who retired within the last 5 years, and if you do the quick math, that's right about 2020, 2021. So it's been a crazy 5 years.
It has. Give
them credit. But for these people, they found only 40% said their spending plan is working. So that leaves 60% saying their spending plan is not working. 21% of respondents said they are having to cut back, which makes me so sad.
Absolutely. And most of the time, what I have found is it's completely avoidable.
Okay.
Right?
Even sadder, right? Yeah.
Yeah. I mean, it's one of those things where when people see that they've done a good job saving, let's say that they have an arbitrary, I've saved $1 million or 1.3 million, or I've hit this certain age, and they look at what they have, they're almost always, it's just how we're trained. We're looking at a number. Well, that's the amount that we've saved.
Yeah.
But the real question is, awesome, you have that number. Now, what can that number do for you and how it generates income that we could spend? That's unfortunately where so many of us, we're missing a piece.
Okay.
We're just missing a part of that puzzle. But many of us, because we've never done it before, imagine, Heather, trying to put together a puzzle where you've never seen the front of the box. That's what a lot of us are actually doing. We have a 1,000-piece puzzle. All of the pieces are in there. They're not even hard. It's actually a really well-designed puzzle, but we've never seen the front of the box. We have no idea what it's supposed to look like. That is what an income plan for most of us looks like.
Okay.
We knew how to go to work every day, show up on time, punch our time clock, get everything right, do the right things to the right bosses, to get the right promotions, to get the right bonuses, to put all that money away. Right. And we get to this point where it's time to retire. And unfortunately, we don't have a proper spending or income plan. And that is what derails us. So if only 40% of people say that their income plan is in line, I believe it. I would honestly say I think that number is maybe a little high. I think that, in my opinion, less than 20 to 25% of people actually have a written income plan for spendable income in retirement.
Okay.
Less than 1 out of 4. So if 40% say it's on track, or only 40%, then that tells me something that I kind of already believe. All we have to do is understand, when we get to this point, how do we spend that out as income? Because when people say it's off track over the last 5 years, it's kind of like, retirement a little bit is like a marathon. whatever our tempo is for those first 5 years, it's kind of like the first few miles.
Okay.
That tempo will set the tone for the rest of the race, whether we're able to complete it, whether we burn out too quickly. And this is like spending, right? So if we overspend in the front end of retirement, it's kind of like doing that marathon where the first 5 miles, we go way too fast.
Sprinting.
All of a sudden, what starts to happen? Our body starts to cramp up.
Yeah.
We can't feel right. Our feet just start to immediately worry. And then all of a sudden, our mind gets in the way. Like, oh my gosh, I went too fast. Now I have to do blank. Now I have to do blank. Now I have to do blank. And we start getting over inundated with all of our anxiety. That's typically what happens. So what we want to make sure we're doing is that as we're utilizing the concept of retirement as a marathon, once we get to that point, it's not the finish line. Once we finally retire, it's not a finish line. That's not a trophy at the end. When we get to the finish line, that's actually the starting gun of a completely new race.
That's right.
Where now we've crossed that finish line to get to retirement. Now the marathon really begins. The next 20 to 40 years of creating income and creating purpose in a meaningful existence so that we can be happy over the next 25 to 30 years. And that is where so many people, unfortunately, they don't plan for it or they don't get it right.
Well, that's what you are here to help us figure out, Jon. By the way, if you want to go ahead and set some time on the calendar to meet with Jon, it starts with an initial no fee, no obligation phone conversation with one of our advisors. 502-317-0840 is our number. 502-317-0840. You can also go to retirementsolutionradio.com. You were pointing out some ideas there about things you're seeing people do wrong. The idea like starting off with the sprint or the marathon, spending too much too soon. What other mistakes do you see people making? Can we go as specific as just with the income plan where you see people making mistakes that can be avoided?
If you think about it, income and retirement is the ultimate outcome.
Right.
If people just had, I know that I've given the story 1,000 times, but I'm going to do it again because it's so poignant and it shapes so much about me.
Yeah.
My grandfather had nearly $10,000 a month, every month that came in from guaranteed pensions. They were either from the federal government, the Department of Defense, or the state of Tennessee, and they were going to come heck or high water. That money was going to come in. He almost didn't have to have any other plan because of the money that came in. Now, imagine and think about that for a minute. If you had in retirement $10,000 that came in every month, would you really have a whole bunch of fears? The average person wouldn't, especially because my granddad, when he worked, he never made more than like 35 grand a year ever in any given year when he was working.
Wild,
so his retirement was 3 times better. Right.
Look at me. Let's go to Walt Disney World. Let's go to Missouri. Let's go do all the things.
Exactly. So even if on paper he didn't really have any other assets, as long as he didn't have a whole bunch of debts, that income was the ultimate outcome.
Yeah.
That gave him the freedom to do whatever he wanted, whenever he wanted, with whomever he wanted, as long as he wanted it, right? That's the big thing. So a lot of people, we focus on the number. How much have we saved? How much did we grow? But we're not thinking about, but what does that number mean? What can it do for me? Can it give me $7,000 every single month, come heck or high water, regardless of market performance, regardless of what happens in the administration, regardless of what happens geopolitically, regardless of what happens with tax rates or the Fed? And that's what a really good plan should do. Income is the ultimate outcome. So if we just focused on an income plan, then most people would have an unbelievably successful retirement. And let me give you an example. So I'm gonna call her Carol. Carol had done everything right. She'd saved almost $900,000 by the time that she retired at age 63, right? So she had a small pension. She was going to turn on her Social Security at 67 because that was her full retirement age, but she'd saved almost $900,000.
Yeah.
Everything was going to plan. Here's the amazing thing. She came to us not before she retired. She came 14 months after she had retired as a referral from her daughter.
Okay.
Let me tell you why. So Carol had done everything right. She had everything together, but what had happened, and her daughter said, Jon, she just seems a little anxious. She just seems a little not right. She seems not depressed. She seems anxious all the time.
Yeah.
And when she came in and met with us, we looked at it. She actually had a yellow steno pad and she pushed it across. And she said, Jon, I look at my bank accounts and my retirement accounts every day, twice a day.
Yikes.
I see every single thing that has ever been pulled out of those accounts. And here's what I did. I needed to do a light kitchen remodel because I was in the house every day. I had to have it done. I actually needed to help my daughter with a wedding plan. And so we did that. I was obviously going to do that. I had to do that. And my son was doing really, really well, but he lost his job and I had to help him out a little bit too. So those three things all happened in the first 14 months of her retiring. None of them were reckless. Not a single one of those expenses were reckless. They were reasonable.
Yeah.
But those reasonable expenses that happened in the front end of her retirement spent $94,000 of the $900,000 she'd saved.
Got it.
Amazingly. And what she said, and what she was like, I don't know how to keep doing this because I've gone through so much. And it's true. She was pulling out nearly 10%, a little bit more than 10% of her savings, and she knew it wasn't going to last. But what she didn't have, she had tremendous savings. She had done a great job. What she didn't have was an actual written spending plan that made sure that reasonable expenses didn't cause her to have an unreasonably negative retirement. So all we had to do was go through it and let her understand there are certain types of expenses that we need to plan for because all of these things just compounded all at once. Could she have spread them out? Maybe. But the main thing was having the permission to spend the money she needed to. And let me put this into context. So Carol spent $94,000 in her first basically 14 months of retirement. That was not only way too much, it's kind of like outpacing yourself at that front end of the marathon. You know, you've got 20 plus miles to go and you're already feeling the pain. Can she make it? She absolutely can, but it's going to have to change her thoughts and change her reasoning. What we did is we went in and just showed her none of those expenses were bad. She did nothing wrong, but those expenses are going to change a little bit of the math on what she needs to do next. When we looked at her income plan, but then we compared that to her tax plan, her health savings plan, basically her healthcare costs down the road because she was single, and basically her overall maintenance, what we discovered was there were so many things that she wasn't considering in that. We changed her budget. But what that allowed her to do was to feel confident that every single month when the income was coming in, she had permission to use it. We also created what we called a life happens bucket, where we basically had about a full 2 years worth of income, not to be blown through, but to understand if we blew through more than that, it was going to cause bigger issues. But that was the only account that she needed to look at with consistency to know if this happens. What it did is it gave her a completely different sense of understanding because we finally said, no, when this money hits your bank account, you have permission to use it the way you need to. Pay for, the improvements around the house. Do these things, but spread it out. By doing that, she got a completely different mindset, and she realized her money was not going to go away. She was still going to be perfectly fine, but she was living then within a system, one that she could control within reason, but also understand there was a lot of flexibility, a lot of room to maneuver, and it gave her complete freedom. She said, the only reason I didn't do this, John, is because I thought by having that regimented plan that I wasn't going to be able to do the things I want. But she realized by having that regimented plan, having those buckets properly done, it gave her tremendous freedom and flexibility to do the things that she wanted. Not everything she wanted, but most of the things she wanted if she planned for it correctly. That is what gave her the freedom to actually act well in retirement.
Let's begin the conversation helping you understand about your plan, your money, your future. It's retirementsolutionshow.com or just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.